Hello, welcome back. Previously, we have covered liquidity and profitability ratios of companies or stocks. In this chapter, we want to look at valuation ratios. So, valuation ratios is a mean to actually evaluate a company to see if it's undervalued or overvalued today. The first one we want to look at is the price to earnings ratio, or commonly known as the PE ratio. If we put it into a formula, we are taking the current share price per share over the earnings per share. Assuming that company A has a share price or stock price today at $4.80 and the earnings per share is 80 cents, you take 480 divided by 80 and you will get 6, a PE ratio of 6. So the value of 6 here indicates how many times more are people willing to pay for the share or the stock. Okay, so this gives a company a valuation against current earnings. So for instance, with a PE ratio of 6 today, people are willing to pay 6 times more of its current earning to buy the share. Yep, so you can get some companies with very low PE, or you could get some very exciting tech companies with PE ratio of more than 100, which means that based on earnings today, people are willing to pay 100 times more to buy the stock in anticipation for future growth. So generally, if you look at the top right corner, the arrow is pointing downwards. So we want to look for stocks that have relatively low PE ratio, which means that it is less expensive today. In the example of a fruit store owner, how do we look at price to earnings ratio? For instance, let's say you want to buy a stall in the marketplace. You look for a stall and you found one stall that makes $1,000 net per year. So typically for private businesses, people are willing to pay 3 to 5 times more based on its current earnings. So for this instance, the PE ratio is 3, which means that you're willing to pay $3,000 for this store, assuming that the store has $1,000 in net earnings and you pay 3 times more of that net earnings. So PE ratio is a way to evaluate a company, whether it's undervalued or overvalued today. However, PE ratio by itself just tells you how many more times are people willing to pay for the company or the stock. More indicatively, you should look at PE to growth ratio, or PEG. The formula is quite straightforward. You take the PE ratio from how we calculated previously, divide it by the company's growth rate, future growth rate to be more specific. So in this example, you have 6 divided by 12%, assuming that the growth rate is 12%, you will get a PEG of 0.50. So the PEG ratio is showing the current price and earnings against future growth. So it is really the way to determine if a company is expensive or cheap at this very moment. So in the example that a tech company, a new tech company with exciting technology can gather a lot of investors' interest, it could bring up the price extremely high to give a PE ratio of more than 100, for instance. But assuming that in the next 5 years, for instance, there is a growth rate of more than 100%. So technically, you would have a low PE to growth ratio, which means that it technically is not too expensive because it has the capability to generate very good income in the future. So remember, PE ratio by itself is not indicative enough. So you couple it with the company's growth rate and you use the PEG ratio to determine if a company is expensive or cheap. Top right corner, arrow is pointing downwards. So the lower the PE-G ratio, the better it is. In the example of a fruit stall owner again, the PE to growth ratio, in this example, let's say you want to buy a fruit stall today, and you are only willing to pay 2 times more of the stall's earnings. And you anticipate that this stall that you are about to acquire can grow 20% every year. So the PEG is 0.1. So how do you calculate this? You take the PE ratio of 2 because you're willing to pay 2 times more, divided by 20% growth rate, you will get a PEG of 0.1. Before we move forward, the growth rate here, if you want to find out for a stock, you can simply go to stock screeners or financial analysis web pages to look for a growth rate that many different financial analysts or the company itself puts on. So you don't need to assume or guess, but this data is fairly readily available online. Moving on, we look at the price to book ratio or the PB ratio. If we put it into a formula, we are taking the current share price or the stock price divided by the book value per share. So to get the book value is basically the net asset value, where you take the total assets of a company, removing off the intangible assets, deducting off total liabilities, then you will arrive the net asset value, or what we call the book value. So it's basically a value that you put on a company, assuming that the company don't run today and it liquidates everything it has, pay off all its debts. How much value or worth is it left with? So in this example, assuming the share price is 480, the book value per share is 240, then you will get a price to book ratio of 2. So it's a mean to measure a company's market value against its book value. And it is also a way to determine if a company is expensive or cheap. Top right corner, arrow pointing downwards. The lower the PB ratio, the better it is. Because assuming that if you have a very high price to book ratio, this means that the share price is extremely high and your company today does not or is not worth as much. So the higher the PB ratio, it sort of means that your company is very overvalued at this moment. Think about a fruit stall owner, assuming that the stall's market value is $10,000 today, right? So you have valuators or people or your neighbors saying that, yeah, your stall is worth $10,000 today. But in actual fact that your stall's book value is only $8,000, assuming that you own that shop and you have some debts to clear off. The book value is $8,000 today. So if someone is offering you $10,000 to buy your stall, basically the person that buys is paying 1.25 times more, or 25% above the book value. Assuming that you close the store today, you liquidate everything, you can get $8,000 back. Yep. So price to book ratio is to compare market value against the book value or the net asset value of your company today. Moving on, we are looking at the price to sales ratio or the PS ratio. Similarly, we are taking the current share price or the stock price over its sales or revenue per share. So the difference here between PE and PS ratio is that for PE ratio, you're taking the earnings per share or the net earnings, while for PS ratio, you are taking the sales or revenue per share. Simple maths, if the current share price is 480, you divide it by 320, assuming your sales per share is 320, you will get a PS ratio of 1.5. PS ratio is a means to show how many times more are people willing to pay for the share or the stock, and it gives a company a valuation against its current revenue or sales. So the lower the PS ratio, the better it is if you look at the top right corner with the arrow pointing downwards. Because if you have a PS ratio of say 10, this means that it is slightly on the higher side because based on your sales today, people are willing to pay 10 times more, and it doesn't justify us as an investor to pay 10 times more, for instance, based on your current capability to generate sales. So the lower the PS ratio, the better it is. Back to the example of a fruit stall owner. Let's say you want to buy a stall today. You found a stall in the market. You know that the stall makes $1,000 per year in sales. Remember, sales, not earnings. You're willing to pay $1,500 for that stall. This means that the price to sales ratio is 1.5 times, or you're willing to pay 1.5 times more of what the stall can sell in a year. So I noticed that there is a typo here. The PS ratio should be 1.5 if you are willing to pay $1,500 for that stall. Next, we want to look at price against cash flow, or price to cash flow ratio, or PCF. So in this whole chapter, when we talk about valuation, we are always using the current share price or the current stock price against different factors or variables. So for price to cash flow, we are taking the current stock price against the operating cash flow per share. So, investors wants to know, right, based on the share price today, how much cash are you generating or getting into the company. So for this instance, PCF, share price of 480, operating cash flow per share is 240, you will get a PCF of 2. Arrow is pointing downwards, and again, it's just another means to give people an indication of how many times more are people willing to pay for this stock or share, considering the current cash flow to the company, or operating cash flow. So very simply, it gives company a valuation against current operating cash flow. So to get this operating cash flow, you can find out in the cash flow statement as we have described earlier in the last few chapters. We're coming to an end in this chapter on valuation ratios. A quick recap, we have covered price to earning ratios, PE ratio, price to earning against growth ratio, PEG. We have price to sales ratio, we have price to book ratio, and lastly, we have price to cash flow ratio. So similarly, you can see a trend. We are always comparing the current share price against different factors within a company, whether it's against earnings, against sales, against cash flow. Different investors have different way of using these ratios, but just a quick tip here is that very commonly, doesn't matter which country you are at, people are normally looking at the price to earnings ratio and the price to earnings against growth ratio, because earnings is basically the most important factor or variable to an investor. It doesn't matter about sales so much, because if there are no net earnings or the net earnings is extremely low, no money can be used to reinvest in the company or to be distributed as dividends, right? So we have different valuation ratios, but from my point of view, I think the two that you need to look out for is the price to earnings and the PE to growth ratio. Thank you, and we will speak again in the next chapter.